Thanks, Dave, and thanks everyone for dialing in today. Now, it is a key juncture for the market. We've had strong 12-month returns. We've got a number of global policy issues at the moment with the taper talk, the debt ceiling, German elections, and we've got a domestic government change as well. And there's a lot of questions that I'm being asked by investors. And today what I'm going to do is answer what I think are the 5 key questions. First one is whether the US economy is able to battle its way through the headwinds that it's facing. The second one is about China, whether there's a bubble which is about to burst. Third one is whether our domestic economy has the potential for a renewed downturn. Fourth, has our market run too far? And finally, where are the opportunities in this market? Now, I'm going to answer each one of these with specific regard to Australian equities, but up front I'm going to give you 5 key conclusions. The first one is that we think that the global economy can continue to have a gradual recovery. Secondly, we think that the clear message from policy setters are that they want growth to occur and they're going to do everything they can to ensure that comes through. This is supportive for equities. Thirdly, the Australian market, while it's had a good run, the foundations are solid and we do not believe the market is expensive. Fourthly, we think there are a lot of stock-specific opportunities out in the market today. That creates a great opportunity for active managers. And our portfolios have the highest conviction levels we've seen in a long time, and we're already seeing that coming through in strong performance. And you can see that on that table where we run through the BTIM equity different products, and you can see their strong portfolio performance from all of those funds. The core fund over 5% calendar year to date. The focus fund, which is a concentrated version of our best ideas, is beginning to come through in terms of more leverage to those ideas and continued strong performance from our mids, smalls and micro-cap fund. Let's turn to the first issue, which is the US recovery. And we start with a photo there of the Piceance Basin in Colorado. This is shale country, and shale really has been a revolution in terms of the US energy industry. What we have now is the US leading the way in terms of global shale. It is now, as you can see from the following slides, having a dramatic change in the direction of oil production in America. That's leading to a fall in imports. Of the 5 fastest growing states in the US, 4 are shale states, so it has a meaningful effect on growth, both directly in terms of import substitution, but also indirectly as it requires substantial investment in the industry and also is providing cheap energy, which is good for other industries such as petrochemicals. This is a key pillar of the US recovery. The second pillar is the consumer. Now, we don't expect the consumer to grow strongly, but we do think they can sustain growth around 2%. And that's because the balance sheets are improving. And you can see there, gearing is falling and service ratios are improving. The third pillar of the US recovery comes from investment. We've had 10 years now where investment has been well below long-term averages. That's left a huge amount of catch-up. And we think some of that catch-up will come through in the next couple of years. So the US economy, despite the policy headwinds, despite the talk of taper, despite the debt ceiling issues, we think can continue to grow above 2.5%. That's good enough for equities, and that means we still like a number of US exposed stocks like Fox, like Amcor, like ResMed. Let's turn to China. Now, the issue in China is whether there is a bubble and is it about to burst. Why are people concerned? Well, there's some good reasons. We've got a photo here of what looks like the Eiffel Tower. Unfortunately, it's not the Eiffel Tower. It's actually a suburb of Hangzhou in China, where someone's decided to build a replica, 1/3 size of the Eiffel Tower, and thrown in a few sort of French-looking streets alongside that, right next to a cornfield. This is a sort of frivolous investment that I guess people question as to what that means in the long run for China. Now, China short-term is actually seeing an improvement in growth. And that improvement in growth is to do with some short-term factors. The government has accelerated some investments. It's been a hot summer, and that has helped growth. But the real issue in China is that there's been too much debt supporting growth. And what you can see there is a dramatic rise in debt, and they've needed about 3 times as much debt, or $3 of debt for every dollar of GDP in the last few years. That is unsustainable. That's what people are worried about. Now, that debt has manifested itself in excess capacity in a number of industries such as steel and aluminium, and that's driving down returns. So when you look at these issues, you can see why people are worried. But what we believe will happen is a slowing of growth, but not a busting of any bubble. And the reason for that is twofold. If you look at that chart on returns of industrial companies, what you can see is a very strong, vibrant private sector. China can deregulate industry, allow the private sector in. That will improve productivity, and that's what we expect them to do in this November plenum, which is critical in terms of setting the policy direction of the new government. The other reason we don't think China will have a bubble that is about to burst is that as it stands today, its still overall debt is not large enough to be a major concern. It's still lower than a lot of other countries, and if they deal with things soon, they can deal with the problem. So China, it will slow, but we do not believe it's going to cause a major problem for Australian companies. The opportunity is in companies that are exposed to commodities that can have resilient prices and benefit from a weaker Aussie dollar, which we think will come through. Let's move on now to the domestic economy. What we are seeing right now in Australia is a potential gap in economic growth as the mining capex cycle fades away quickly, 8% of GDP down to 2% of GDP. That presents a significant gap for policymakers to feel. The way they're dealing with that is cutting interest rates, hoping for the currency to fall. We're seeing some signs of life in housing, but we believe the real opportunity is a bit of a pickup in what has been a moribund consumption environment that we've seen for 5 years. And there's some early signs that the low interest rates are beginning to feed through. The problem has been confidence, and you can see from that consumer confidence chart mapped against consumer sentiment that people have been very cautious for a whole variety of reasons, and that has held back consumption. The interesting development, though, is that we look at some surveys, we can see that people are beginning to shift their mindset. Previously, they just wanted to pay down debt. Now they're beginning to be a bit more confident, prepared to take more risk, and you see that particularly in the desire to buy housing. Finally, we've also got clear signs that the wealth of Australians is beginning to rebuild. House prices are picking up, equity markets have improved, and if people believe that that is sustainable, then they will not feel the need to save quite as much. We don't believe we see savings fall all the way back to where they were 5 years ago, but at 11%, we think there is some room for a fall in the savings rate, which will help the domestic economy, and that will help some of the domestic cyclicals in the transport sector and the retail sector, stocks like Asciano and JB Hi-Fi. Let's turn to the fourth issue, which is the market, and whether the market has run ahead of itself. We believe this is not the case. We think the market is well supported, and there's 2 reasons for this. The first one relates to the rating of the market, the price-earnings multiple. This is something you can see we track back over time to 92, and we also map that against interest rates, and we invert the interest rate. So lower interest rates means that the market rating tends to rise. We're just about around the average market rating, and that is consistent with the low level of interest rates that we have today. So we do not believe that the market has re-rated too far, and we also believe that interest rates, by staying low for a reasonable amount of time, allows the market to stay at the current rating. The second perspective is earnings. Earnings also tend to improve as interest rates come down because it's normally consistent with an improving economy, and we measure this with earnings revisions against interest rates. We haven't yet seen this coming through yet, but there were some early signs in reporting season that companies, by adjusting their costs, are able to deliver on the expectations that people had, and if that continues with the tailwinds of a falling currency and potentially a better consumer, we could see earnings beginning to be the driver of this market. So while the market is no longer clearly cheap, we think it's good value on a long-term basis. Let's turn to the final issue. The final issue is, where are the opportunities? Now, the market has very much rotated over the last year towards defensive yield stocks. We no longer believe that is the best place to be in terms of investing. If you look at that chart which measures some of those defensive stocks against the bond yield, you can see there's been a very strong linkage. And with the bond yields beginning to back up, even with some short-term volatility, we think they're either heading sideways to slightly down, and therefore we do not see these defensive yield stocks outperforming the market as they have. And the important point here is a lot of retail investors have money parked here. They're in the banks, they're in the insurance companies, they're in Telstra. I don't think those stocks are going to fall dramatically, but they're not going to deliver the returns that people maybe are expecting. So the question is, where are the opportunities? And if you turn to the chart which looks at yield versus the growth in dividends, you can see a number of areas where we think the opportunity is, because that's where the market will move to. It's the stocks with the high dividend growth. It's in industrials, it's in energy, and it's in diversified financials. These are the companies which are either seeing some cyclical profit growth, seeing a reduction in CapEx, seeing improvement in earnings as those investments pay off, and that leads to strong free cash flow generation. You can see that with two examples we gave you there, which is Asciano in transport and Oil Search in the energy sector, where yields could move towards or above 5% over the next 3 years. The way you make money in this market is moving ahead of the pack and moving to the point where people will see a change in perceptions, and it's these stocks which are not seen as high yield stocks but will become high yield stocks we think are the opportunities. So pulling all that together, we've got a collection of names there which we like, whether it's US exposure, whether it's domestic cyclicals, beginning to see an improvement in underlying earnings, whether it's companies with strong dividend growth. These are the names which are in our portfolios. They're beginning to perform, but we think they will continue to perform in this market environment. So to summarize, we see a global economy that can continue to grow, supportive policy settings around the world, a market that is not expensive, and a lot of stock-specific opportunities. Our portfolios have high conviction. We're seeing that coming through already in active performance, but we think that will continue, and we're very optimistic about the outlook for the variety of products that we offer. Again, we thank you for your time and for your support.